Good afternoon. It is Tuesday, April 21st, 2 o'clock and change. I'm really excited, pleased to present the next episode of Lumida Non-Consensus Investing. There's a lot going on out there. Here's some topics I want to get through today. One is I call it the Claude Reverse Uno card. It was the title of my FSD video yesterday. I'm going to elaborate on that and some posts I've shared recently on X and in our newsletter. I'll talk about bank earnings, which came out. I always love to see what bank execs are saying and the status of credit. You get that through earnings season. The big banks just reported earnings. There's a lot of insight to the economy that's invaluable there. Take a look at that. We'll also talk about SpaceX, the AI trade, markets, positioning, and if you've got some names you want me to take a look at, maybe you can flag them. We can do that here too in the next 45 minutes or so. So with that said, let's get started. I'll start off with this post I want to share. I wrote this this morning, really building off a thread I'd shared, the prior week around kind of the thoughts in the market. Like overall, as I stated in our last podcast, we believe this is a bull market. This is a non-consensus rally. A lot of risks have been discounted and priced in. There's a lot of cash on the sidelines. People need to get back in, and the bottom is in. The lows are in. That doesn't mean that you don't get a bit of retracement. In fact, it's quite often the case that after monthly options expiration on Friday, which is what we just had, you get a small pullback. In fact, I made that point a few days ago here in this post. But overall, the bias should be to be bullish. I'll be very brief on the recap around that. You can take a look at the Lumida Ledger newsletter. You can look at my last podcast. But in short, forward valuations dropped 20%, which is pretty consistent with a significant correction, even though the S&P dropped 9 points. Earnings estimates kept marching higher, in part driven by the AI trade and continued CapEx spending. We've now got governments involved with AI, and we're seeing real productivity impact. So look, it's a bull market. That should be the bias. It's important for people to update their state of the world and be mentally flexible. The way I would look at this, I wrote this post called Zoom Out. Let me kind of walk you through it here. Look, markets move in cycles, and there's certain parts of the market that move faster than other parts of the market. I call those like marginal liquidity markets. It's faster money, they discount information quickly. Things like Bitcoin and crypto assets are part of that, more speculative parts of the market. So back in October 10th of this past year, we saw essentially a simultaneous top in things like crypto, in unprofitable tech, in quantum stocks, in story stocks. Are all about the future, the AI data center trade, and then we start to see them roll over. End of October, we saw Sam Altman, CEO of OpenAI, give a pretty awful interview with Brad Gerstner on the BG2 podcast, where he's getting very defensive around the traction on OpenAI and their capital funding needs and how much money they're spending and how much money they're losing. And then in November, December, we saw more weakness permeate data center names like Oracle. Their senior executives started selling their stock en masse. We talked about it at the time. And the data center name came under pressure as people started asking questions on the sustainability of CapEx spend. Then in January, you had the Armada buildup around the Strait of Hormuz. You also had peak Goldilocks as the S&P hit all-time highs even as there's weakness brewing under the surface. We wrote about in our newsletter that we thought it made sense to take chips and risk off the table. And then, of course, you had the Iran conflict. Coupled with the Iran conflict, you also had private credit fears that was hitting private equity stocks. And you had death by Claude. Claude was cranking out new product releases seemingly every other day, and every time they had a release, it created devastation in a different part of the market, including things like software and SaaS and names like Microsoft and other pockets too, including financial services. There was hysteria around Claude. So that's where we've been. By March 31st, we had a very interesting set of events. We had Berkshire Hathaway trading at multi-year lows on price to tangible book value. We had Meta trading at 17.5 times earnings. We had Microsoft trading at 20 times earnings. We had legitimate value start to present in the market. And we started to see that bad news was no longer sinking stocks. That's the crucial thing. We saw excessive hedging. We saw excessive short interest. And when everyone's seeing the risk, and the risk is in the headlines every day for 3 weeks in a row, that risk is usually priced. Whoever's wanted to sell, they sold. So now where we are is we believe that this is a non-consensus rally. It rhymes a lot with last year. It rhymes a lot with last year, almost to the day. And, that's a shift. It's important to be attuned and recognize and be aware of these shifts. Crypto's been off the low for a few weeks now. You're seeing a reversal in those dominoes that were falling from October through February, which I just outlined. Those dominoes are now getting rebuilt. Software has been rallying off the lows. You've seen retailers, which are impacted by tariffs. They bottomed on March 20th, well ahead of March 30th, actually leading the market. So you're starting to see these dominoes rebuild. Financial services, which dipped below their 200-day moving average, they're now over the 200-day moving average. Tech stocks are rebuilding. The data center AI linked names are moving up now. So we're seeing those dominoes rebuild. That's what we're looking at. And even though the S&P is around all-time highs, there are so many names that are down 10, 20, 30%. We believe those are where the opportunities are. Even though the overall broad market indices have recovered, there are a broad range of opportunities that are out there in the market. And what makes this correction unique is that many names also have quality. They have economic resilience. They're businesses you're supposed to own. They're businesses that when they go on sale, they got great customers, they got earnings growth, they've got good valuation, they've got a moat, they've got a dominant leadership competitive advantage. We think you're supposed to buy them. So I like that. I like that characteristic about the market. No one's got a crystal ball about what the future holds, but if you can buy a quality business when it's on sale, then when those clouds part, those names will revalue. A lot of names are trading low because they're discounting a lot of risks. When you get to normalized earnings environment, those names will trade at higher prices. So you should be contrarian, you should be contrarian, you should be constructive. That's our view. I'll walk through some names. We could easily walk through 15 to 20 to 25 names, by the way. I can only call out a few names here, but we will seek to do that. So I titled this the Claude Reverse Uno card because what's happening now is, we can stop screen sharing this now, but what's happening now is that, Claude went from wrecking ball for the economy. How do you stop sharing that, Paul? Is there a way to stop? There you go. Claude went from wrecking ball for different sectors of the market to now single-handedly reviving the AI trade. You can see that in semiconductors, in industrials, data center providers, names that were beaten down like Oracle, other data center providers have rallied as well, like the CoreWeaves of the world. Software names like Microsoft are back up. So Claude went from wrecking ball to rejuvenation, and people believe in the productivity story. I think the demand for AI is real. You're still seeing sovereigns get on board with this. The Department of Defense or Department of War is still trying to sort out their approach to AI. You're seeing the importance of autonomous drones. Lumina, we made a private investment in Shield AI about 3 months ago. They do FSD, autonomous drone guidance. We think the world's moving towards drone and defense tech refactoring. People are seeing the power of all of that. We think it's real. It's got legs. The spending will be there. The productivity gains are there. I think all of us in our own private lives are seeing that impact. I'll share a funny anecdote with you. I was at a coffee shop 2 weekends ago. I was reading a wonderful book by the legendary investor John Templeton, and across from where I was seated, there was an elderly couple, easily 75 plus. There was also a younger individual, maybe their niece, in their 20s, and they were all talking about AI. But more importantly, they were all familiar with AI. They were talking about specific tools in AI. They were using AI. They're talking about their use cases, and they were sharing with each other the joy of AI. That's called high net promoter score. That's called natural adoption. It wasn't driven by a marketing process. It was driven by value, legitimate, tangible value. I know at Lumina, we've incorporated AI substantially, top to front, left to right, you name it, around our organization. We built an AI investing app called Lumina Invest. You should check it out at luminainvest.com. But even our internal workflows, we're getting more and more productive with AI. If you're an early adopter in AI, you're going to benefit. And that's true for these Fortune 1000 companies that recognize that. These CEOs aren't knuckleheads. They're going to invest in the future. They know that if you can be more productive, you can get more impact created per unit of time, labor, or capital, then you got to do that. So they're going to invest heavily in AI. So I think that's the big gestalt shift that's happened here. That's something to consider. Let's shift gears here. We'll move to bank lending. If you have any questions, keep them coming. So I'm going to shift over to the Lumina ledger here. And we've got Brian Moynihan. I used to work for Brian Moynihan back in the day when I was a senior vice president at Bank of America Merrill Lynch. Bank of America bought Merrill Lynch. I was relocated down to Charlotte. I joined the management team in the cards and deposits unit. It was quite an experience. And the Bank of America is almost as big as the Defense Department. I mean, they have so much data, loans, people. You get a real-time view in the economy. And some of that experience has shaped my view on how I look at things. So I think Bank of America has got more data than the Federal Reserve, right? So let's take a look. So one of the things Moynihan said, the CEO of Bank of America, is that the consumer balances and consumer spend is healthy and growing. So that's a key takeaway. I want to know that number. Our consumer spending is up 6% year over year. That's at a rate that's faster than nominal GDP growth. That's a very good sign. Okay, so consumer is fine. 65% of spending in the economy is driven by the consumer. The consumer spending and household balance sheets are strong. That's what matters. Here's another fun fact for you. So the typical consumer spends 4 to 5% of their debit or credit card spend on gas. With the spike in oil, that number went to, guess what number? Take a guess in your mind's eye. It was at 4 to 5% before. Now it's at 5 to 6%. That's not a big number. I mean, I could make it scarier. I could say they spent 20% more on gas than they did before. It's only 1% higher. The US economy can stomach and can tolerate that. It doesn't mean that people aren't going to feel pain. There will be pain felt, especially in the bottom half of this K-shaped economy. But that can be digested by the overall economy. That's the key point. That's the key takeaway. So the US consumer is fine. I believe that this economy can handle $80, $90, $95 priced oil, as long as we don't go above 100 for a sustained period of time. That's the key thing. So we'll see. If there's a risk, someone's asking, Ron, well, what about Iran? Well, look, risks that are front and center of the market get priced in, right? It's been in the market for so long. The market knows there's a conflict in the Strait of Hormuz. Okay, market knows that. That's been discounted. what is the left tail surprise that markets don't know? You can make the argument that the conflict is longer than people expect. Okay, that's an interesting argument. There are a lot of C-17 cargo planes doing an airlift. Okay, that's been done over the last few weeks or so. Your left tail risks are some kind of escalation. We haven't seen that yet, and there are always risks, of course. I can't predict that. No one can predict that unless you're in the White House or on Polymarket, and you're tracking that one account that seems to get every trade right. So I hope the SEC looks into that, by the way. So what you can do, though, is find good businesses at good prices. That's what you can do. That's in your control. And as an investor, those are things you should be doing when prices are on sale. You want to take advantage. Find great assets when they're mispriced. So what else? In the Lumina Ledger, we talked through a few different names here. I kind of want to make the next Lumina Ledger just on ideas because there's so many of them, but we cover quite a lot of ground here. I'm going to show you this chart real quick. This shows the positioning of long-short hedge funds. I like this because these are investors that set prices. Hedge funds set prices, quantitative equity funds, the Citadels of the world, they set prices. Passive investors don't set prices. You're seeing there's been a lot of degrossing. What that means is hedge funds delevered. They took their net exposures down quite a bit. They're 50% net exposure. This is near lows. They got lower in April. This correction is not as severe as what we saw in April, but it was significant. It's consistent with corrections we've seen in 23 and 24. And there's room for these players to re-lever now, which is what they're going to want to do. If markets go higher, they will be forced to chase markets higher. So that's the background condition in the market. Okay. I wrote this past Sunday, there's a legitimate chance of a 2 to 3% pullback in markets. This would be quite normal. I think you're seeing some of that yesterday and today, but this should be a dip that should be buyable. That's our point of view. We also talk about reading inside the mind of Trump and how his decision-making is done. There's a great Wall Street Journal article published over the weekend, and it gets you into the kind of decision-making utility function of Trump. I think this is important to read because, I think there's a lot of people that stepped out of the rally or stepped out of the correction from last year. They didn't get back in the market. They said, hey, Trump is going to take the economy over the cliff. They're having that view now. And I think that's something you don't want to be doing. Look, what drives stock price in the long run are earnings. Number one, earnings. Earnings growth is strong. Okay, we're going to have double-digit earnings growth year over year, driven by the CapEx spending, driven by government spending, more fiscal deficits, and a consumer that's also strong, which I talked about. Okay, and the second is valuations, and valuations have come down quite a bit, as I mentioned, and interest rates are still behaving fine. Those are your three primary drivers. Sentiment is also washed out. Positioning is cleaned up, meaning people have a lot more cash. This wasn't the case a few months ago, but it's the case now. So when the facts change, you should change your mind too. I'll refer you to the Lumina Ledger to see more about how do we see Trump's decision-making process. But my headline statement is that he's pragmatic. He's not ideological. He's conscious about midterms. He wants to get past this. It's clear that they miscalculated the duration of the conflict. They thought it'd be done quickly. They did not expect the Strait of Hormuz to be closed so quickly. They got all that wrong, but that's also the rearview mirror now that created the opportunities that we have in front of us today. So that's our view there. Focus on asset prices. That's the key thing, right? We might disagree on how Trump makes a decision, but focus on where you see value and opportunities. That's the area we have control. Areas I'm less excited about would be like industrials. This is definitely a non-consensus idea. I look at the industrials ETF XLI, and it's almost at 2021 valuations. I don't like that. What's causing the bid in industrials? Well, it's because they have earnings growth through reindustrialization of the United States, through natural gas generators, through building all this data center infrastructure. I'm not a huge fan of this category. It's pretty much the same idea as semiconductors, are kind of like the same idea. Not a huge fan of that. You know, you have stocks like Corning, where the management team is selling their stock. I'll see if I can pull that up on the Lumina app for you real quick. Again, go to luminainvest.com if you want to get the app while it's still free here. To come back here, Corning. Let's go to the insider trading. I'm doing this with a Mac, by the way, rather than my phone, so I've got to kind of get familiar with that. But you can see there's a lot of insider selling at certain names here. Getty Images is a funny one. This is a company that's going to get disrupted by AI. They sell the stock art. And, okay, this one's not pulling up. I might be doing something wrong, or maybe it's not on the Wi-Fi. So we'll come back to that. But you should take a look at the app. I can see insider sales by company. You can see executives at CoreWeave are selling shares, a lot of shares. You can see Jamie Dimon at JP Morgan is selling some shares. So, you know, not one data point is decisive or determinative, but together these data points can build a mosaic. And that's what you want to do here. So what we're doing with the app, by the way, is when you connect your portfolio, the app will notify you if executives are buying your stock or selling your stock, or if you have a watch list, then the app will notify you when someone decides to buy as an insider, for example. So, you know, that's an interesting thing to do. It also notify you if technically some of these opportunities are set up for you as well, right? So you can go build a watch list here, and the app will keep you informed. Okay. So what else? So let's shift to a few different topics. Let's talk about some of the opportunities that are out there. One is, like, I think on the AI trade, Taiwan Semiconductor, this remains a top holding for us. We like this name a lot. It's cheaper than NVIDIA and all the semis, and it's got a dominant market position. It's a monopoly. It's got momentum. It's up 151% year over year, and the valuation has essentially been unchanged. So, you know, it's been unchanged for the last couple of months. There was a great bargain buy when it got down quite cheap to 14 times earnings in April of this past year. But, you know, this name is a toll gate. All roads pass through TSM. We think it's a quite interesting name. The memory complex we think is interesting too, right? The forward earnings growth on these names is strong. This is a bit more of a consensus idea, but still the names are cheap. You know, they have earnings growth. So the way I would look at a name like Micron is that so long as it's maintaining trend, you know, it's worth owning. If it breaks trend, then you should get out, because it's a very high momentum name. It's up 500%. The forward P is 5 times, so it's still cheap. These are cyclical businesses. At peaks, they look expensive. The demand for memory is strong. They have pricing power. They're passing it on to consumers. Apple will pay a higher price. But yeah, this is a trend. This is a trend. So if that trend breaks, you should get out. You know, back in 24, it was known that one of the constraints would be memory. Okay, but it didn't matter. The name broke trend here. You were supposed to get out, wait for it to reset, get back in. Right now, the trend is strong. So that's how I would approach a name like Micron, or if you wanted to do a name like SanDisk, you know, for example, around semis. You know, let's talk about biotech. Biotech has had a really strong run. There was a false breakdown in biotech here. We were actually shorting it around here. Then there was a bunch of strength that we saw in biotech around the lows. This is a big short squeeze, but it is constructive. It is bullish. So there are some names in biotech that may be interesting. You know, markets that are unique juncture right now. Like there's a natural moment here for biotech to pull back and reset. If it's going to do it, now's the time. You're on the other side of options expiration. The way that works is things that run up the most going into options expiration last Friday are often the things that give back the most in the week after. It's a phenomena that we and others have noticed in the market. But if you're going to play in biotech, here's some interesting names. For example, like Amgen. Amgen is a profitable company in the biotech category. Most biotech companies are not profitable. This is an interesting name. It's up about 30% in a year. We like this kind of technical pattern. I call this a wick. You're seeing buyers step in at these levels, and at these levels, kind of looks like a hammer. We like to see that feature. It suggests that they're buyers here, so you've got less downside. That's an interesting way to play it. You can see there's a good amount of EPS growth. The 4P on this is 15 times, which is cheaper than S&P 500. So you're getting value, you're getting momentum versus the S&P as well. Not a bad idea if you want to play in biotech category. We may own these names, by the way, or we will be buying them, or we have bought them, so keep that in mind too. Not financial advice, do your own diligence. Here's Bristol Myers Squibb. This has got a 4 PE of about 9.5 times, trailing 17 times. It's also outperformed the S&P over the last year or so as well. That's an interesting area. If I look at pharma is in one of these it's got to make up its mind. Is this thing going to rally or is it not going to rally? It's kind of in a state of indecision. I point this out because the way Pfizer and Merck and some of these biotechnology names will move will likely be driven by what's happening at the index level with IHE. Here's Pfizer. That also looks interesting. Here's Pfizer. That's not a bad setup. That's not a bad opportunity here, actually. Again, it's outperformed the market. It's got good valuation. It's got momentum as well. So the real risk is if this broader ETF, the pharma ETF, continues or breaks down, kind of in a point of decision. But my bias would be to participate in some of those names, and if they don't work, then you can always just exit, cut your losses quickly. That's it. That's how I would approach this. Some other names. I'm going to throw names that hopefully you guys haven't heard about. That's the whole idea of being non-consensus. But here's an interesting name. Right? So consumer stocks really took a hit with oil prices going higher, right? That means less disposable spending. Funny thing about Domino's Pizza, people love Domino's Pizzas for a long time as shareholders. People used to marvel at how this was almost the perfect quality compounder. It had beaten the S&P for something like a decade plus. And then it's gone nowhere. It's down 20% over the last year. People forgot about Domino's, right? And that's typical, right? At the top, people get excited, consensus piles in, you're somewhere like this, and then the thing just kind of rolls over. Another name that comes to mind like this would be Chipotle Mexican Grill. It was the stock that can do no wrong. And then in May, we were actually critiquing the stock around May of 24, if you find what I said on Twitter, right around here, actually. Anyway, so then the thing broke down, and, we'll see what happens. It's trying to get out of this downtrend, probably isn't done with it. It's still too expensive, right? Not much earnings growth, and we'll see. But Chipotle is going the path of Domino's. Cava went down this path too, right? So here's Cava, right? Remember Cava? They have the $16 salad Mediterranean bowls. So Domino's could be interesting. The bear case is that restaurants as a theme are under pressure. This doesn't look like a perfect setup for me, just to be candid. I'm just trying to highlight areas of opportunity where you might want to consider. I would say prices are probably higher a year from now, probably higher by a decent amount a year from now. We're probably in the later stages of this turning from like a bear market to a bull market. I might want to keep an eye on something like that. So we talked about Pfizer there. What else? So let's talk about some other topics here. Let's talk about SpaceX. SpaceX IPO is coming. Okay, I'm going to share some thoughts on that. SpaceX. So this will be a highly anticipated IPO. Anthony Scaramucci, guy whose thoughts I respect. We wrote an op-ed in the American Banker together about 2 years ago, by the way. We were trying to advocate for innovation in banking and a deregulatory approach to permit more competition in banks. Banks need competition. They need better consumer experiences. They need to incorporate stablecoins. The world has caught up to where we are, which is great. Thought leadership still matters. But anyway, so Anthony, I'm going to criticize Anthony on this one, though. So we're on the same side back then. Now we're on the opposite side here. He says, I own SpaceX. I participated in a private round. I was also an investor in XAI. He says, now here's my honest read. The cult of personality around Elon Musk gives his companies an excessive premium that's off the charts. That's true. I agree with that. Tesla is suffering and still carries a valuation that defies conventional metrics. That's true also. I'd agree with that too. Tesla, by the way, they're also buying all these affiliates of Elon, his other businesses like XAI. So the Tesla shareholders are getting diluted, and then the acquirees get liquid stock. So, you want to be the acquiree, not the acquirer. SpaceX is reportedly raising $75 billion. That would be 3 times larger than any IPO in history. That's a massive offering. I'd be a seller of that. I wouldn't be a buyer of that. We see this every cycle, okay? Every cycle. Let me walk you through memory lane. When Goldman Sachs went public in the dot-com era, that was one of the top signals. You were within like 9 months of a top, okay? When Blackstone and Apollo went public in the 2007 era, that was also a massive top signal. And these are all great businesses, by the way. It's not a knock on the business. They went through bear markets. When Blackstone took Hilton public, that was a sell signal too. So this is a massive float. We haven't seen the S1 yet. I believe they filed it confidentially. We haven't seen the numbers. I'll do a breakdown on it if you guys are curious. And I was talking to Claude. Claude thinks it has a 40 to 45 times price to sales ratio. That's bananas. In 2021, which was the peak of the market, we saw price to sales ratios of 20 times. So, this is liquidity. This is just liquidity for insiders. I would be making an avoid on that. Anthony goes on to say, hey, I missed Amazon. I had a chance to invest in Amazon. SpaceX, the next Amazon. I don't want to miss that ride. There's a big mistake Anthony's making here. Here's the mistake. When Amazon went public, it had a 500 million market cap. Okay, 500 million market cap. It was a small cap. SpaceX going public at like $1 trillion valuation. You make your money on the buy. Your return is your exit price divided by entry price. If your entry price is $1 trillion, it's hard to find an exit price that's 10 times that. And competition shows up when you have profits, right? That's what makes capitalism so remarkably effective. Blue Origin is getting in the business. Amazon is getting in the business. They're looking at deliveries too. So competition is the enemy of returns. So I'd be careful around that. I'd be careful around other IPOs like OpenAI as well. So I think there's gonna be a lot of float on the market, and that could set up a risk-off condition later, but that's a time for another day. That's a time for the future. We'll talk about it, in the future. SpaceX moves up vesting schedule for employee shares before IPO. No kidding. They're gonna get liquidity. They want to preserve the psychology of the employees who might see their stock prices decline. Okay. So what I would do is, I think in private markets, defense tech is a good. Private markets are very expensive. Defense tech is one of the few categories that are interesting. We did a deal I mentioned earlier with Shield AI's defense tech related. They have it's autonomous software for drones so they can guide and fly themselves. I'm summarizing at a very simple level. The only words it's missing in that are like lasers, quantum, and like uranium, I guess, to make it even more exciting. But it's got all the magic buzzwords. But more importantly, it's priced well. It's got government contracts behind it. It's got a moat, technology. It's on theme, earnings growth, and at like a 12 billion valuation, it's got room to run if you compare it to like Anduril at 60 billion plus. So we like those kinds of ideas. I'd be doing that in private markets, but I think private markets are very expensive. Look, when you see Robinhood start to manufacture new investment products, be careful, be skeptical of what Wall Street sells, right? Like they're putting Databricks in that. Okay, well, SaaS stocks are down 80%. Databricks is still being carried at the last round. It hasn't accounted for mark to market. I'd be skeptical on all of that. What else? So any questions? So there's a question that's coming in here. Your take on you want to flash out the psychedelic sector? Do you have let me know if you've got a ticker. I can take a look at the ticker. Just show that question on screen, Paul, if you can. There you go. I just tap it. Boom. Just did it myself. That's cool. So, psychedelics are one of those things that can potentially change the world. They had a pump after Trump signed an order that's going to make it easier to access therapeutic psychedelics, such as ibogaine. This is a category I've spent a lot of time researching. I read a book by Michael Pollan. He's a phenomenal writer. You listen to some of his podcasts, you might find them very interesting. I think there's extraordinary potential around this. I interviewed Danny Goyle, who has done a lot of research on this, especially around DMT. So I think there's a lot there. We can remove the comment now. I don't know if that works. There we go. But here's the thing. That's a trade. It's not an investment. Why? Because there's no earnings. There's no earnings. There's no earnings. Okay. It's like cannabis. You guys remember cannabis? Cannabis was a theme from a few years ago, opening up more cannabis dispensaries. Those stock prices went up, but then they fade because there's no enduring value capture. Okay. It's not a pharmaceutical. You can't put a patent on it. You can't charge high prices, capture a high price margin. That's the issue. I looked at this theme several years ago. There were a number of companies, including the Canadian market where there's less regulation. There are companies like Field Trip, for example, that were having clinic, like outpatient care services. You walk in for a treatment and you're out the same day. And those businesses never found out a way to make money. It's kind of like WeWork. Remember WeWork? It's like WeWork for psychedelics, for therapeutics. They just couldn't make money. It doesn't mean that another business model won't come along and find a way to do it, but that's not there now. So just appreciate for what it is. It's a trade. When that trend breaks, you should get out. I don't think that's investable. Another one that I could go on and on about this whole category. Funny thing about psychedelics is very much like quantum and these other kind of world-changing thematic ideas is that they're really just narratives. They're narratives. They're just trades, like 3D printing. Remember 3D printing? 3D printing was going to change the world, and then it didn't. Now no one talks about 3D printing anymore. It is changing the world. It actually legitimately is changing the world, but it's not priced like it used to be, right? So that's why I put that in that bucket too. Okay, what else? Did you look into AMPX? I haven't looked into this. I'll take a look. Thank you for letting me know. Maybe in our next podcast, we can talk about AMPX. I can check on the Lumina app if they have a view as well. If it's a South Korean name, AMPX. Yeah. Oh, Amos. Again, my typing is not as fluent here with this kind of setup here, but looks like we'll have to add coverage for that. So it looks like it's a South Korean name. I don't know the name. But drones are thematic. Their momentum plays. Their trades too, by the way. Just keep all of that in mind. When the trend is in your favor, it'll work. If it breaks, like say the 20-day moving average, and get out. That's the way to do that. Okay, their trades and then their investments. I do think now's the time you can make some great investments now. As I mentioned earlier, there are a lot of names that are trading at discounts. We'll share more of those. One other thing I'll share with you is like just energy. Obviously, energy prices have come down quite a bit, but energy security should be a powerful thing. Many countries around the world, including Europe, are saying they need energy security. They need energy storage. They need renewable energy like solar. Enphase has been running the last few weeks, for example. Enphase Energy for solar might be a beneficiary here. They need nuclear energy. they need oil and gas energy. That is going to be a top 3 priority for many sovereigns. So I think energy infrastructure, energy equipment, that's still a good category to focus on. I don't think that's a thematic trade. These names have pulled back in recent weeks. I think there's opportunities in this category. So stay tuned for more. We'll share more around this. There's some ETFs that index to this category as well, if you want to keep it simple. For example, XES is the oil and gas equipment ETF. The name is run up. What you can do in the app, by the way, is I can pull up a theme or even an ETF like this, and then I can take a look at the top holdings of the theme. So energy's been pulling back today, but you can see Schlumberger, Baker Hughes, Halliburton, FTI, and the AI will do its own independent underwrite. That's what these greens are. More greens, the better. There's a trader AI that looks at the technicals of it too. So for example, if I were to type in FTI, so this is a competitor of Schlumberger and Halliburton. This is a name we've written about in our newsletter. We happen to own this name too. I can even get technicals. These are daily candles. I'll shift to a weekly candle view because weekly views strip out the noise. Okay. Names like this are at a key juncture. These are what are called demarked candles. Red should denote kind of bad, right? So 12 is usually when you get a kind of reversal in these things. So, these are a bit overbought. If these reset and provide more attractive entry prices, this could be an interesting category, okay? But you get a bull case here. Here's your bull case. Revenue's up 18%. I won't walk through the rest. You've got a bear case as well there. And then the trader is saying, hey, you should trim your exposure. Sometimes you can have a bullish setup, a bullish fundamental read. This company is legitimately growing revenues and earnings double digit, but the technicals are no good. And the trader AI will actually tell you exactly why. I'll tell you exactly why. So it's saying, hey, Ram, I don't like this, and this is why. This name failed to track above the recent moving averages, et cetera, et cetera. I won't walk you through the rest. Technicals do matter, by the way. Technicals do matter. You want to light up fundamentals and technicals and get your thematics right. You can also go on to see who's buying the name from their quarterly holdings that are published in their 13F filings. This is as of December, so consider that. These are the folks that have been buying, the AQRs, Bridgewaters of the world. Here have been some of the sellers, the Two Sigmas, the Millenniums of the world. The quants are selling, and some other folks are buying. So pretty powerful app. Again, go to lumidaainvest.com. There's also real-time news feed. It's like having a Bloomberg terminal in your pocket, and it breaks out by category. If you want to get your life back, you can click Trump Watch, and you can see what he's saying, because he does move prices. You got to know what he's saying, but you can see what's going on there and not have to, stare at a screen. And you can see what themes are working or not working. So I would actually flip this. Where we are now, I would look at themes that haven't worked in the last 1 month, right? I'd look for some mean reversion type opportunities, click 1 month return, and then reverse the sort. And now I can see, energy's pulled back. And I can start to see where there might be opportunity. Nursing homes, that would attract my attention. We need more senior living care. Are there opportunities in senior living care? I've got 1 minute left, and we're going to call it a wrap. So I might look at names in this category, for example. That's how I might use the tool for idea generation and discovery. And I say, okay, maybe one of these names is worth further study. All right, so we'll call it a wrap there. Hope you guys enjoyed. Again, you can follow this on YouTube. Go to YouTube, type in Lumida Non-Consensus Investing. Go to Spotify, type in Lumida Non-Consensus Investing. If you want to get the app, go to lumidaainvest.com. Let us know what you think. I sincerely believe it's the best investing app in the world right now, and we're making it even better. All sorts of integrations and feeds that we're doing, and there's a lot more to come. We're rolling out the buy the dip indicator today on this app. We're rolling out a market color feature like within 24 hours. So it'll tell you, if you had bought stocks that had dipped, would you make money or not? It's a proprietary indicator. Stay tuned for that. It's going to come out next 24 hours. All right. Be well. Make it a great week. Enjoy your spring break. Take care.